we often talk about sustainable finance, but certainly it's not a new topic to either of you or to us. And as we sit here in London at the Global Financial Centre, sustainable finance has been talked about a lot. My question to you is thinking about how is it that we take sustainable finance to the next level? What innovation are you seeing within the financial sectors to be able to use, hopefully, the data that CDP is helping to support, but also to really innovate within this space for good? Jane, I'll come to you first.
I think there is lots of opportunity for innovation, and certainly over my time in sustainable finance, which has gone past the 25-year mark, I must say. But I think we've seen innovation for over the decades, and I think that won't stop. In fact, I think we need to see an acceleration of that innovation to really try to help scale finance directed towards sustainability opportunities and challenges, and also make the whole system more efficient as well, because what we need to do is make sustainable finance the easy thing to do, and so that we can get capital to where it's needed most quickly.
Great, absolutely good call to arms. Daisy, from a 91 perspective, what innovations are you seeing that excite you?
Well, as an asset manager, obviously, we're here to manage our clients' money. And I think the innovation we've really seen is the mainstreaming of sustainability. I don't know if it's just to do with the kind of millennials coming forward with their pensions and wanting to do good, but we definitely see appetite for integrating sustainability, wanting money to do good as well as making returns. But I think that has an impact on how we think about it. We have to be able to find those opportunities where you really can drive returns as well as having positive sustainability impacts. And I think we've seen a big range of products emerging that do that, and a lot of learning about what works and what doesn't. But it's very exciting that, and I would agree with Jane, the scale issue is vital. If we're going to have real positive impact, we need to get to scale of sustainability outcomes. And that does mean a range of products, a range of opportunities across different asset classes, not just treating sustainability as sort of impact funds and a very narrow niche thing or a response to regulation, but how do we really integrate this? And particularly, how do we focus on outcomes? Not just, managing risks, but actually driving positive change alongside generating those returns. And I think that's where we really focus, is how do we create sustainable products that are about returns alongside impact, not a trade-off or a narrow niche product that's on one side of a portfolio.
Yeah. Really important message there, which is that you don't need to choose. Actually, both can come together if the job and the innovation is done right. Speaking of innovation, speaking of products, Jane, with the London Stock Exchange Group, indexes, benchmarks, these sort of constructs that actually CDP is playing a role in as well. Our data drives and our scores drive a number of benchmarks around the world. How do you see these sort of products as driving increased attention on ESG, on sustainability, but also on just really moving money at scale?
I think it's really important, actually, and the point you kind of touched on was around asset classes, and I think we are starting to see this kind of universal adoption of sustainability mindsets in different asset classes. So when we think about capital markets, we can look at the fact that we're raising sustainable capital in the debt markets and the equity markets, and looking at the financial market infrastructure that's really important to underpin asset allocation decisions such as indices and benchmarks. And in that area, I think it's really important that we're providing the tools that investors need, like I said, to make it easy. So, we are in the business of providing indices and benchmarks through FTSE Russell. And at last count, we have something like over 120 indices, which are either sustainability, climate focused or ESG. And we have roughly, well over 250 billion tracking those indices. And that's just a demonstration of the fact that when investors want to either track performance or kind of invest passively, effectively tracking an index, then they can do that if the infrastructure's there. So we have a wide range of different indices, and they are becoming much more sophisticated as well. So if you think about kind of climate data, we've got indices which are enabling investors to invest in companies and issuers who are kind of transitioning. So climate transition indices. If you think about kind of implied temperature rises, that's that sort of data that's into indices, getting much more sophisticated and responding to kind of the innovations that investors are wanting to put in place.
That's great to hear that the demand is there for these products, and being able to create the subtlety. I think that investors are trying to make sure that they're moving their money the way that they want to, which is great to hear. ISSB, again, you know, from an investor perspective, this is a great harmonizing global standard baseline. LSEG has come up very clearly in support of ISSB. Obviously, CDP as well, considering we are the global key partner for implementation for them. So how does this affect some of your product sets? What are your investors saying? And that must have encouraged you to lean into the ISSB.
Well, I think the fundamental point is that for businesses to execute on their business strategies and investors to allocate capital efficiently, we all need information. And we need information which is comparable, consistent and high quality. And for that, we need global standards. We need a global agreement about what information is relevant and how that should be disclosed by companies. So ISSB, in our view, is a game changer because it does exactly that. It really does seek to introduce a global baseline for disclosure. And that's why we, together with other partners, have led this call to action. And really what that does is it calls on governments around the world to adopt or commit to adopt ISSB at pace by 2025, because obviously we know that the implementation timeline can delay things. So it's really important that we see that global adoption without unnecessary alterations. So we really sort of stick to the pure baseline. We have over 120 signatories in support of that call to action, which was launched just a couple of weeks ago. And I think the number was something around over 10 trillion in support of that. So we have a lot of investor signatories and company signatories, so people can join that call to action as well still.
Well, couldn't agree more from a CDP perspective that harmonization of the data sets that are feeding into investment decisions, also feeding into procurement decisions, feeding into decisions made for business efficiency. You know, frankly, these aren't all separate data sets. You know, they're often the same piece of data. So if we can harmonize the questions that we're asking companies, I think that is going to bring huge amounts of efficiency, not just for the financial stack, but also, as we see it, being able to use that same information for other use cases, which sounds like a good way forward for all of us. Daisy, I wanted to turn to you. You've just recently launched a report that really started talking about how the financial sector needs to address its approach to net zero. I'd love to hear a bit more about that and how that starts nudging us into thinking about transition and what comes next.
Thanks. And yes, we recently launched the paper really, again, thinking about that evolution. What have we learned over the last 4 or 5 years of investors starting to think about how you manage climate risk? And that has involved, you know, supporting the transition to net zero, thinking about, you know, emissions in our portfolios, but how we also drive real economy change. And I think what we've seen at 91, and I think many of our peers have recognized, is that for obvious reasons, we focused on measuring our financed emissions. Like any company who's looking at their emissions and getting to net zero, you're focused on that number. But it doesn't work so well for investors because actually what happens in our portfolio doesn't really matter a great deal when it comes to emissions. What matters is what's happening in the real economy. We don't live in our portfolios, we live in the real economy, and what is happening to emissions towards net zero in that real economy is the most important thing. And really the proposition we put forward is that we should stop focusing so much on just the financed emissions number, which is also often backward looking, and start really to think about, well, how as investors is our capital driving that transition to net zero in the real economy? How do we move from just thinking about reducing our financed emissions to financing reduced emissions in the real economy? And that involves a different set of metrics where you're looking at not just what a company emits now, but what is their transition plan, and having the data to understand how are those companies going to transition? What is the forecast for those emissions reductions? And then how do you allocate capital behind that? So the concept of transition investing is well known now, but still relatively new in terms of those standards. But it's really important for thinking about, well, how are we going to have that biggest impact as an investor towards achieving net zero in the real economy? And that comes through supporting the technologies that are going to get us there, allocating capital to the companies that need investment to transition, particularly in emerging markets. And often those technologies technologies, those companies have high emissions now. You're going to get the biggest impact from getting those high emissions towards low emissions, but it does involve investing behind that. And I think that idea of how do we measure what we're actually achieving in the real economy becomes really important, and that's what we put forward in the paper as a kind of evolution, I guess, to the approaches to net zero we've seen from investors historically.
Yeah, I love that term evolution because I think that that's what we're all working towards. You know, we started this conversation about sustainable finance, and that transition piece is something that, you know, is a very much a forward-looking consideration. And at CDP, we love the idea of a transition plan because actually it needs two things fundamentally. It needs a target and it needs a baseline. And then you need to track between that baseline and your target end date. Ideally, that is a science-based target, so that actually we are all aligned, again, you know, to sort of pull from what you've said, Daisy, to thinking about the real economy and what it is that we're all really here talking about, which is actually making good decisions for a climate-positive future. And of course, finance plays a huge role in that. So, Jane, you know, with that, you know, in mind, you know, as companies come to the London Stock Exchange Group, either as a listing or through their bond issuances or any of the products that are listed there, how important and how many questions are about the future? How many questions are about that transition that they're planning to do, as opposed to perhaps just something that could be audited, which is in the past?
So I think the whole point around transition is really important, and we do, and that's another area that we're kind of really keen advocates for, is around the publication of transition plans. And the reason why it's so important is because this is really a tool to move the debate on from publishing emissions, setting targets, transition plan, that's the how, but then enabling the building and kind of the connection of the capital there. So this is a continuum, and a transition plan enables investors to be able to allocate capital in a really transparent way. So on the bond side, we have the transition bond segment, and then on the kind of equity side, we have companies who are potentially transitioning. Maybe they could secure the green economy mark, for example. So there's lots of ways that we're trying to encourage companies to be more transparent and sort of thoughtful around the transition that they're undergoing, and to avoid a situation where we're talking about a binary debate here, because we don't think that that's particularly helpful in terms of, are you a brown company or are you a green company? Actually, the whole economy should be transitioning. So I think we are seeing lots more questions from investors, but also companies curious to know how they stack up, how, you know, what does good look like. We've been involved in the transition plan task force, which is starting to try to set out what a kind of good stand of a climate transition plan could be, and LSEG itself has tried that out. We've tried to put our transition plan through that lens, and it's a really helpful framework to think through, you know, all the elements that are at play.
Absolutely, and CDP also participated in that transition plan task force, and actually some of the questions that we ask regularly through our questionnaire are in line with really tracking what data points, what information do you need to be able to think about that transition plan. And Daisy, I wanted to come to you with a word that is being bandied around in the market a lot, which is credible, a credible transition plan. And I think, you know, it was before my time, but I believe that CDP coined that phrase first a few years ago when we were starting to think about how that tracks. And according to some of the data in 2023, actually there is only less than 1% of all the companies that disclose through CDP that would be considered having a credible transition plan. Now, before we start bemoaning that fact, we are definitely on a journey, and we hope that this year we're going to see a lot of improvement on that. But what's your reaction to that, Daisy? In terms of being able to allocate capital, how do you take that credible word and make it useful?
It's something we think about a lot at 91 because we assess all of the highest emitters in our portfolio and look at their transition plans to assess the ambition, the credibility, and also the implementation. And there are a few things that become particularly important to investors, and it often lands with, you know, are the component parts of delivering a target there? You can set a science-based target and you can set out some vague kind of description of how you might achieve it, but actually are the main components that add up in terms of actions to delivering that target in the plan, and is there capital behind them? Is the OPEX, the CAPEX that you can see allocated to that with a forward look? I think the main challenge, even for the companies that are producing those more credible transition plans, is often we're asking to do something companies don't do in any other sphere. We're saying, please tell us to 2050 how you're going to run your company. And no one publishes that information for any other part of their strategy, really. And I think that's where we have to be realistic. We focus a lot on the plan till 2030. We want that to be based on existing technologies that are viable, to be able to see that those are financially credible. Ultimately, we're investors. We want these companies to make money, so we have to know this is a financially viable plan. And then we're looking at, well, what is the company doing about the things in the future that may not be so certain? It's fine not to be able to tell us what CapEx you're going to allocate in 2035. But are you doing the things, creating the partnerships, investing in the innovation that you might need to do the things for the more longer-term parts of your transition plan? And I think that's where we're still evolving as to exactly the detail or the level of assurance we need on those parts of the kind of longer-term plan, while wanting very clear detail on the short-term parts of the plan with that real financial element, both in terms of, is this going to keep the company profitable over that short-term investment horizon, and does the plan sort of stack up in terms of the component parts actually delivering that science-based target that we look for.
It all sounds very logical, and I'm glad that we're thinking it through with such detail. How does a sectoral overlay impact what you're talking about, Daisy? Because earlier today we talked about various different sectors. We talked about the cement sector, the steel sector, retail sectors, and of course some of the hard-to-abate sectors are in a quite different place than perhaps others that are more quickly moving along their transition pathway. How does sector reviews come into play when you're looking at companies to invest in?
It's really important because, of course, if we're going to reach net zero, we're going to need to do something about those hard-to-abate sectors. Those companies are going to need to transition, and not all the technologies and solutions are there. So when we look at, say, a pharmaceutical company that set a science-based target, often reaching the majority of that target is going to be based on, well, what's happening with the national grid becoming greener, and there's almost an automatic transition that will happen for that company, irrespective of what they do, or a large part of what they do will be taken care of for them. When you look at steel, cement, oil and gas, this involves, a whole change in business model or a whole change in technology, and that is much more complex. And so we need more detail, but also it's a more complicated set of things we're looking for. So are the partnerships with customers or the policy advocacy with government? If you're going to need a technology to be subsidized to develop it by government, are you advocating for that to happen? Or are you just sitting back saying, well, we'll transition if the conditions are right? And I think that's what we're really looking for, are all of the levers that those companies in hard-to-abate sectors need to be focusing on to get them through that transition. Are they really doing all of those things that they can do in those areas, particularly where there aren't immediate solutions now which they can implement themselves automatically?
Yeah, makes great sense, and it sounds a lot like it's a big company game. A lot of these things in terms of lobbying and policy making and really sort of advocating for what needs to be, often that's more difficult for smaller companies. And Jane, we spoke before we started this conversation about different sizes of companies and how they're accessing capital and whatnot. I mean, what's your advice and what's your perspective on companies that are perhaps not yet listed or part of that grouping that has got a very high focus, especially from mandatory disclosures around the world, but are maybe fast growing or looking to access smaller markets, the AIM market as an example, or others around the world to aim for 1, 2, 3 years time to be an IPO on various markets. What's your advice? What's your sense in terms of how you could guide them?
Well, I think coming back to the credibility point, actually, because I think this is relevant here, is that I think I'm a firm believer in focusing on the things that matter. And a piece of research we did recently actually was around disclosure of emissions. And that showed us that when you look at the larger cap end of the spectrum, the FTSE All World, of those companies, most of them, at least 70%, are disclosing Scope 1 and 2. But when it comes to Scope 3 emissions, which we all know form the majority of most companies' footprint, only 45% are disclosing Scope 3 emissions, and of those, only half are disclosing the most relevant categories. So what we're seeing here is that companies are not always kind of showing the full picture. So what I would advise perhaps smaller companies to do is really kind of get to grips with what your emissions are, the different scopes, and focus on how you capture that information, because that will stand you in great stead to have a really solid baseline from which to then put in place plans and actions. And often it's going to be in the value chain where those emissions are. So good relationships with suppliers, good relationships with customers, and thinking kind of very holistically around the carbon footprint is super important.
Great. Maybe good relationships with CDP as well. We can add to that list.
Yes,
fantastic. Yeah. Well, thank you so much for joining me today. Super interesting, and thank you for all the great work that both of you are doing. Thanks for your partnership. And back to you, Marla.